Good afternoon, folks. Welcome to Top Gun Stock Trading Educational Session. And this session will be on Equity Trading 101, the basics. All right. First thing you need when you're starting to trade is you need some sort of you need a broker and you need a trading platform. Your broker can be Charles Schwab, it can be USAA, it can be TD Ameritrade, any broker will do. Secondly, you need some type of trading platform. You basically need some charting software. Now, most of the brokerages have their own trading platform and charting software. I use a couple brokers, but one charting software I do use is Thinkorswim's by TD Ameritrade, and I've become more comfortable with it trading, and I can manipulate it. Basically, you need to figure out what you're comfortable with. You need to get the information you need when you need it, and you need to know how to read the information that it's trying to tell you. All right. So here at Top Gun Stock Trading, we try to keep trading as simple as possible. You go to these other sites and they'll have stochastics, they'll have relative strength indicators, they'll have ADRs, ADXs, slow stochastic, fast stochastic, I don't know, whatever, all kinds of BS, frankly, on how to trade the market. You'll see lots of Bollinger Bands and all kinds of nonsense. We here at the Top Gun Stock Trading teach the basics. I got the price action, candlesticks, I have some moving averages, I have the volume, and down here at the bottom I do have stochastics, though I do not trade off of them. The only time I ever look at this stochastic is when stocks are at their all-time highs or lows, and I get just as another input into my decision on whether the stock is weak or strong or whatever the case may be. But as far as any other times, I hardly ever look at that. I just have it up there so I can easily refer to it when I'm looking at stocks at the highs or lows, like I said. So basics. Now again, every trading software is going to be a little bit different, but all in all, they're going to have the same information. You'll want to set up your charts in a similar way. On the x-axis, you have time. On the y-axis, you have the price of the equity. I've set up my charts to a candlestick pattern with simple moving averages. Now I have 4 shown here, although the 100 is 100 moving averages I rarely use. I just have it up there for my own essay. Just kind of a case study on how much the 100-day or 100 period moving average offers support and resistance. But basically the 20, 50, and the 200, you can throw in the 100 if you'd like. 20, and it's on close, so basically the 20, in this case 20-day moving average, is basically the average of the last 20 days of trading action on its close. All right. It's likewise the 50, 50 to 100, and 200. Depending on what time frame you're on, we're in the day. Daily time frame is what actual periodicity is. If you go to the weekly, you're now averaging out the 20 past weekly closes, 50 past, 100 past weekly closes, 200 past weekly closes. That's why a lot of times you'll just see MAs next to whatever moving average is, because it's based on what chart it's showing there. So in this case, I got the 20, the 50, the 100, and 200. All right. As far as candlestick go, how do I read the candlesticks? Now, when I first started trading these candlesticks, it could have been Greek, Chinese, alphabet for all I knew. They meant nothing to me. But the more and more you look at them, the more and more you trade with them, you're basically reading the mind or the emotion of the market, trying to deduce what the market's next move is going to be. All right. So these patterns, these candlesticks, they make up patterns, and these patterns form intentions, if you will, or tendencies, and that you can trade off of to be a profitable trader. I'm going to expand this a little bit so we can just isolate. On one of the previous videos, I kind of went through this as well. So I'm on a daily chart. Each candlestick, you'll see it's either red or green. What the heck does that mean? If it's a green candlestick, that means the close equity closed higher than what it opened for that given period. In other words, if it's a daily chart for the day, if it's a red bar, it opened higher than what it closed at. So in other words, the stock went down. So on this day, on 12/17, December 17th, the spiders opened at 179.36 and they closed at 178.65. If you look right underneath here, as I move my as I move my thing, my arrow there, the numbers change. But so I'll leave it there for a second, and you can see base of the day, the open price, the high, the low, and the closed is what that's telling you up there. And I use that to determine entry and exit points off my trades here. So wide range bars, these candlesticks form different shapes themselves, and they portend different tendencies, if you will. Wide range bars that close near or at their highs or lows kind of tend to say that they're going to move in that same direction over the next couple days, over the next couple periods, if you will. If you're on a daily chart, obviously a couple days. Likewise, to the upside, wide range bars to the upside say, hey, probably that equity is going to continue moving in that direction. In this case, this is basically some resistance here. You can see it traded right up into that resistance of these other 2 days. It pulled back, did a little consolidation here, and then pressed right through that resistance. So that was a minor resistance. Continued up into the high there. So other candlesticks that can give you hints, points. So you can see there's basically a doji here, basically where the open and close price are very close to one another, or near proximity of one another, thus forming the candlestick, the doji. So looking back, I'll show you a good example of a doji that formed was the pivot. Let's see. When was the low in this market? Let's go back to March of 2009. Way past it. Forgive me. These are the spiders, by the way. So see what kind of candlestick pattern they put in. I think it was March 9th, 2009. There we go. Here's the low. So, as you can see, this pivot in particular at March 6, 2009, basically a wide range, pretty big wick with a narrow body. Doji, in essence, portends or suggests that a pivot is in place. Now, it doesn't always happen that way. As you can see, lots of narrow body candles that did not suggest that, but certainly narrow body candles at highs or lows or at support and resistance certainly percentage-wise may form a pivot there, or suggest that there is a pivot coming. Now, not all pivots to the upside. Now, a reversal peak, I'll get into this in my class more succinctly and step by step, but I just wanted to get you familiar. A reversal is more than half the previous day's candlesticks. In other words, half of this open and close here. Open, close. Let's see, we got about 4 and 4.6, 2.3. So close plus 2.3, 77.75, and the next day closed at 79.52. So it closed above the halfway point of the previous day candles with volume. That can be considered a reversal. And if you saw this, you could buy that close right there at 79.52, knowing you probably get a couple days worth of action out of it. And indeed, 79.52 would have gave you, if you traded exactly to the high, at $90, so a $10 move, almost a 12.5% move. Even if you weren't that good of a trader, and you took took it off at the 20 here. Again, another minor or major support and resistance. In this case, it was a minor resistance level. If you took it off at 89.31, you made 10 bucks, and you still made almost 12% on that trade just by using these two candles with that volume and then taking it off at that resistance line. Now, as you can see, it pushed up through there, and the following day, if you stayed in that trade, if you were greedy, you got burned on it. So the name of the game is don't be greedy. When you're trading, take your profits, take 10% whenever you got it, at least half off to make every trade a profitable trade, and be smart about it. All right. There are lots of other patterns that we trade off of. Here's another doji pattern that made a pivot here. As you can see, going back here, there's a pivot low, pivot high right here on the sell-off. So I would say that those dojis there came at resistance levels, obviously, and they then sold off, continued to sell off into the low there of 2009 and the ultimate low in the market. So the basic shape of a single candlestick can tell you what type of emotion or what might be happening. You string it together a couple candlesticks, and that's going to give you an even better idea of what is in the cards. So I'd like to find a bull flag. Well, let's just go to some of the small caps that I know have either in spirit of bull flags or bull flags. This may take a couple minutes to load. Here we go. Is Aria, Ariad Pharmaceuticals. My computer's very slow tonight. You have seen these patterns because I have shown them to you before last couple days with a couple of the trades I've taken. So with Ariad Pharmaceuticals, a bull flag, I've talked about this before, a move up, sideways consolidation, a move up is going to happen. All right. If this sideways consolidation is slight down, sorry, delete that. Sorry. So if the side is slight down, and spirit of bull flag, looking for the up move. Okay. Now, if you can combine this pattern with a moving average coming up underneath of it, in other words, if the price moves in, if the moving average moves into the price action, you have a better chance of that stock getting a pop here. So look at Ariad Pharmaceuticals. What do we have here? A move up, sideways consolidation, right into that necktie actually, and then you got a pop up. So neckties are pretty powerful. Obviously, when two moving averages come together, they form a necktie. And if you can get a stock price to move right into that necktie, especially off of consolidation off an in-spirit up bull flag, you're going to get a pop 90% of the time. So if I would have caught this back in December 16th, I bought this equity right at the, call it right at the 50 or the 20 right there at 407. You can see what kind of price action you get out of that. 407 to 775. That's almost a doubling move there in 4 days off of that move. Pretty powerful. You can see combine the pattern with the moving averages, and you get a pretty good price move. You get two moving averages there, which is doubly more powerful at the necktie. What a beautiful trade this would have been had I seen it before. Basically, what do you have here? You get basically the same thing happening. You got to move up. You get some sideways consolidation into the moving average. All right. Now, if you wanted to buy this, it wouldn't be a bad trade at 664. You can see it moved up today, 30 cents, so 5% move, but I'm such a stickler for that. I wouldn't even chase that price. I'd wait for it to come back down to 648 if it would. Maybe a flush to 648 and then a bounce or something like that. But I wouldn't pay up at 682 for this stock equity. But whatever the low on this candle is, 644. This is probably not a bad trade. See if we can't get off 644. And then I'd be looking for a trade probably up to the 100-day moving average at 944. Another 50% move. That would be a monster move if you can get that. So I may put that in. I'll write that down. Korea 644 is what my price is going to be for a move higher. All right. So those are bull flags and spirit of bull flags. Bear flags. Let's see if I can't get any ones that have recently played out for you. Here's one right here. The opposite is true. Here's Lululemon just recently. So what we have here, this is perfect. Oh, this is beautiful. Big move down. Sideways consolidation right above my master level, if you will. The 20 moving average comes into price action, and obviously price just pierces that 20 by a little bit, and boom, slams the stock down. What a beautiful move that was. So if you sell this 20 right here, 58.81, you sell short right there, Lululemon. You're a pretty good company. It got as high as 59.84, so you're $1 out of the money, less than 0.5% out of the money before the next day. It closed at 49.70. So you're a $9 move off of 58. I don't know what those percentages are, but that's over 15% move. Just playing this beautiful bear flag into the moving average. Boom, down it goes. As you can see, I talked about this before. This was a master level. It traded right to it and just consolidated above it. That tells me eventually it's going to break that. It's just building pressure up to go lower. And one of the reasons why I did move out of CarMax today, as well as Clint. All right, Clint wasn't one of these cases. There was another case in this. I didn't like the price action, and I moved out of it. Oh, dry ships is another one I'm thinking about doing that. Just monitoring. Again, it's forming a bear flag here, so this is powerful stuff here. So if you know there's these patterns combined with that moving average, you just made some good coin there, 16%. If you bought an option, a put option with that, you're making more than that. That would have been a monster move. Probably for like a $300 option, you probably would have doubled or tripled your money on that one-day move. Probably would have made $500–600 on that option just on that next day. So beautiful move. So there's bear flags, bull flags. We went over platforms, brokerage. Another, if you can't get for whatever reason the stock charts off, I mean this stuff, if you don't have the money, well, there's free stock charts out there. It's called freestockcharts.com. I don't recommend it. It's very clunky software. The stock prices are delayed. You never want to trade off delayed stock prices. Other platforms out there are Speed Trader, Ninja Trader. I got the Thinkorswim right here. It's all what you want and what you need. So we've talked about moving averages. We've talked about the candlestick. We've talked about bull flag, bear flag, and combining those two patterns with a moving average to see what kind of powerful moves that you can get off of that. Two beautiful examples was Lululemon for the bear, and then Aria was for the bull. All right, that's all I have for this. We'll keep it short for this educational video. Again, more to come when I put together the webinar. There is tons more material that I have available that I'm just putting together right now. But again, I'm not ready to go prime time with it. What I'd like to do is do a webinar, actually go to webinar, have members sign in, and it'll be a live trading session. It'll be almost like a Top Gun class. In other words, I should give you the material, give you a chance to ask questions, and again, we don't leave until all the questions are answered. So that's basically the format I want to use. And we'll be using these charts. Again, I'll have to put together some PowerPoints as well. What I like to do, take screenshots and things, and move back and forth so we can get our members up to speed on the education side of it, so we can get you to be profitable traders. Again, avoid the hype. All right, folks, that's it for this session. 20 minutes long. Thanks for joining us, and we'll see you on the charts.